Today I wanted to talk a little bit about the role of alternative investments within a portfolio. Now I'm going to start off talking about Miami Beach. When you picture Miami, you think of sunshine, you think of balmy temperatures, and you think of fantastic weather. But actually, Miami is quite frequently hit by hurricanes. It's right in the middle of the path of several major hurricanes. And once every 10 years or so, it will suffer from a major hurricane event. The point is, when you build your house in Miami, you don't just build it for the good weather. You have to construct a house that can withstand hurricanes. And the same principle applies when you're constructing an investment portfolio. It's no good constructing an investment portfolio that's only suitable for the good times. You need to be able to construct an investment portfolio that can withstand the occasional stock market hurricane. We've had many instances of stock market hurricanes, lots of volatility, very, very sharp drawdowns in the 1920s, in the 1930s, and recently in 2008. Let's just think in a little more detail about why it is important to avoid those very severe stock market drawdowns. If you look at the two example portfolios we have here, you might initially think that portfolio B has outperformed, or you might do a little bit of maths. You might calculate a simple average, and you might conclude that both portfolios give you an overall return of 6%. The important thing to realise is that investment returns don't average, they compound. So if you actually look at how these returns work out when you calculate them properly, you can see that portfolio B, which was the more volatile portfolio, that gives you an overall return of about 12%. Portfolio A, which looked much more boring, much more steady, that gives you an overall return of just over 19%. So what it means is it actually takes a longer period of higher returns or much higher returns to recover from a very sharp stock market fall. So how can you construct a portfolio to protect you from these stock market hurricanes, these sharp stock market events that we get from time to time? Well, the traditional way of protecting your portfolio is to diversify. If you diversify your investments across a range of different asset classes, and if those asset classes are not correlated, so when one is doing well, another might be doing badly, and when one is doing badly, another is doing well, that should smooth out your overall portfolio return so you avoid those very sharp falls in the value of your portfolio. So how do you diversify? Well, traditionally you would diversify by spreading your investments across different equity sectors and across different countries, different locations. And you'd probably also diversify by having some of your assets in fixed income. However, today that might actually not be quite enough. If you have a look at this chart here, you can see that as we are becoming a more globalized world, the countries' stock markets are much more highly correlated. You can see over time stock markets are becoming more correlated, and that means that they're moving together. You can see some sharp increases in correlation in 1987 and in 2008. They are both large stock market crashes, and what it means is just when you need that diversification the most, those markets actually become more highly correlated. So diversifying across different countries, it doesn't really have the same impact that it used to perhaps 20 or even 30 years ago. You could also diversify by investing in fixed income. The issue with that is there has been such a strong bull market in fixed income, in bonds and in gilts over the last few years, particularly since 2008, where the UK government has become a major buyer of gilts. That market has had such a strong run-up, it's actually susceptible to some market falls in the near future. What that means is, if you're looking for genuine diversification, you have to think a little bit more broadly. You have to think outside the box a little bit and think about assets such as gold and investments into property and into new assets that are definitely uncorrelated with the broader stock market. On this chart you can see a sample portfolio. The standard portfolio is a conventional mix of equities, cash, property and fixed income. And the blended portfolio is exactly the same portfolio but with a 20% allocation to alternatives, including gold and farmland. And you can see quite clearly from the chart, it smooths out the overall total portfolio return, so you don't suffer such a sharp drawdown in 2008 and the overall return achieved is much higher. Hopefully that was useful. If you want any more information on any of these topics, or if you want to attend training here with us at Intelligent Partnership, then please get in touch via our website.